Just looking at the market screen right now, and it's been marred with volatility. What with that move at that 11K mark, and then the market completely sold off, dipped into the red a little bit, and now we're again struggling to get back into the green. 10,900 right now. The breath as well has been flickering. So is the market really enthused, and have the measures announced by the Finance Ministry really changed sentiment on D Street? Let's welcome on board Shankar Sharma, Chief Global Trading Strategist at First Global, joining in the show right now. Shankar, hi, good morning. Just looking at the global cues on one end and the Finance Minister's announcements on the other, and wondering what should the market make of it. Good news and bad news both coming in at the same time, Shankar.
Yeah. And the bad news for me is that you're calling right in the middle of my breakfast. So I might have to speak with a mouth full.
Oh, my God. Okay. Okay. Apologies for that. We thought you'd be done and be in time for the ET Now interview. But nonetheless, carry on. You were saying something.
I know. No. Okay. No, so, it's a little bit of a unfortunate thing that these announcements ran in on a day which had a pretty bad Asia and a pretty bad global market on Friday close. So it was always going to be interesting to see what really prevails, which one really wins. And so far, it's I expected a lot stronger market action, which might still happen. Markets can in India we've seen that they do have strong open and they sell off, and then towards the second half of the innings they play a lot better. So it could well end up with a pretty strong game. So, let's just hold our horses. But the larger point is, does this change anything on a secular basis? Or is it just going to be a couple of days or maybe a week or something like that? My view is it's more of the latter, that the market did not fall because of the gas surcharge or any perceived delay in funding and, the PSU banks and stuff like that, but basically the announcement that have come through. That would be taking a very shallow view of what the real malaise is. And the real malaise is, this is a crisis of the kind of proportion that I've never seen on a standalone basis in India. I've seen crises of this kind in 97, 98, 2000 .com, 2008 global financial crisis, the GFC. Those were, coordinated global crises in which India was partaking as it should, as a reasonably sized economy. But actually, India appeared a lot more secure in those crises than the other countries. This time is purely a Make in India crisis. I mean, there is no, global crisis and nothing that the world is coming to an end. The world is chugging along for better or for worse, but there's no 2008 or 98 kind of situation. So India has performed in a very, very disturbing fashion, market-wise and broad economic numbers-wise. I mean, I'm not knocking GDP numbers and all that, because that, we don't know how those are arrived at, but we do know how auto sales are arrived at, or we do know how biscuit sales are arrived at, and all those pointers are telling us that these kind of palliative measures are not going to be enough to really get the economy back on its feet, and which is why this recovery in the stock markets will be short-lived, in my view.
Fair point. But would you say that it's a step in the right direction nonetheless, Shankar? Because last week, same time, we were a little worried, and that really was the chatter all around, that is the government really even worried? The fact that they're acknowledging that there is a problem and they're trying their best, whatever they can in their capacity, to try and resolve it. Would you say that it's the right direction that they're headed in regardless?
The direction is immaterial. It's only timing. All crises can be tackled, provided, first of all, you open your eyes and you accept it. Second, you move quickly, and really, really quickly, instead of sort of telling people that, they're just imagining things. For example, this FPI thing, go back and see from July 5th the kind of statements we have heard from various quarters in various parts of the bureaucracy and the ministries. It's been all over the place, but the central theme has been, frankly, they are collateral damage. They don't add value. They just buy and sell in secondary markets. and all kinds of nonsense like that. I mean, if you have to do this, why let the markets force you to do it? I mean, what has happened today, or rather what happened, by the announcement is that the market forced you to, deal with the problem. Otherwise, we were all sitting arrogantly and telling the world things that, you guys really don't matter. So, why are you creating such a fuss? Or that India is such a great stock market that even if you have to pay a bit more tax, you'll still make more money here. And then the markets tanked, and then they forced their hand, and now you're coming up with all these measures. Markets are very smart creatures. Markets are not idiots. I'm not saying all the time, but I'm saying some of the time, markets are pretty smart creatures. They will read through, that I forced you to come to my line of thinking, and therefore you are weak. And when you are weak, the market can actually, exaggerate and exacerbate that, those weaknesses. So here you've acted in a way which shows that you got rattled. While if you had acted on the evening of the budget day, that yes, sorry, this was a mistake, this was not intended. I know we are retracting it. It was fine. This was over. Nobody would have bothered about it. Now, a month and a half later, you have been forced to do it. Markets will see through your desperation. So that is the real problem here, which is why I don't expect anything very sustained in terms of stock market recovery. I don't think any of these moves anyway are going to aid economic recovery. That requires a very deep kind of thinking for, stimulus. And the real question is, does the government have the money for stimulus, which is a big, big question.
Hopefully, the RBI dividend should try and cough up some of that issue. And the RBI board meets today, and there's all expectation that there's going to be a dividend announcement. So anyway, coming back to what you were saying, Shankar, so you believe that 15, 20 or 1,000 crore rupees of outflows that we've seen from FPIs in the last 2 months, that money is surely not coming back.
Look, I'm not saying that, so don't get a wrong message of what I'm saying. All I'm saying is the FDI outflows happened because of economic distress and not because of this tax surcharge. That would be a wrong reading of the situation. The markets didn't tank so much because of the surcharge. The markets are not in strife because of the surcharge. The markets are in strife because of all the data points, all the commentaries from companies that we've been hearing for the last, I'm not saying just last 1 month or 1.5 months, for the last 4 or 5 months. The last time I was there in your studio, if you remember, we talked about Godrej consumers saying a gloomy outlook, or Lee was talking about recession 3 times in a single commentary. So it's not as if it was just, last post-budget. Situation has been very grim for several months. It's just kind of come home to roost now. So the FDI outflow, and that's anyway very volatile numbers. I don't want to comment on that. But the real point is FDI is to take a long-term view in India. The numbers have to improve. Will they improve? I don't have the answer to that. In fact, the answers are far smarter people sitting in Delhi who can give you answers to that. Can they improve? They can. But in order to make that happen, you will first need to acknowledge that we have a serious problem.
Sure. So, Shankar, not in New Delhi, but sitting out there in Dubai in the midst of your breakfast, what do you think the government can do? We all know, we've talked about this during the budget as well, that the fiscal elbow room is rather narrow at this point in time. We've all seen with the tax collections as well that there's only that much that they can do. What can the government do by way of reforms to try and pick up the economy, which is in a clear distress?
Do you want to hear the politically correct view, or what I would do if I was the head of the country or head of the finance ministry?
The latter, Shankar.
But that's a problem, right? When you say such things, people handle trouble these days.
Take your pick. Sitting far away in Dubai, I don't think that should be a problem, should it?
Oh, that's never a good answer. But anyway, let me tell you what I would do. That's all I can say, and thank God I'm not in that position, because it's a tough position to be in, to be a leader of a country or the finance minister of a country which is facing a sort of slowdown of this kind. It's very simple, in my view. You have to devalue the currency and devalue it sharply. So you need to take the rupee to 80, 85, 90. It has to be a shock therapy to a patient which is, in a bit of a comatose situation right now and sliding past. That move will do several things. First of all, it will bring back inflation sharply into the system. Our problem has been, I've maintained this for years, that India needs inflation, and killing inflation is a Western objective. It cannot be a suited objective for India and India's particular needs. When you bring back inflation, companies start to get pricing power, earnings growth, which is always nominal. Remember, earnings growth are never real. They're always nominal. Earnings growth, which is running at about roughly zero or minus, will start to take back up because companies will have pricing power. So your nominal sales growth, therefore your nominal earnings growth will start kicking back into sort of high single digit, if not double digit kind of territory. That itself will again lend confidence to the stock markets. Inflation will also create headroom for companies to give raises to their employees, so consumption will come back. And then, it will make India a pretty cheap place for foreigners to put capital in. So FDI will keep, come flooding in. If suddenly your rupee is 85, FDI will rush in, and because everything has just become 20% cheaper, FIIs will come in because India has just become 20% cheaper. So you will kickstart a whole virtuous cycle of growth, and the way to do that is a devaluation. And the key question is, will this government do it? I'm absolutely clear they will not do it, because the mindset is that strong everything in every aspect of governance is what we desire. It's fine to be strong on terrorism and on corruption, but to be strong on economic policies, or let's say a strong rupee, which is anyway an overvalued currency, is not necessarily a prudent situation or a prudent line of thought. So if I were the finance minister, if I were the prime minister, this is what I would do. You have to devalue, take it to 85, bring in capital, raise inflation, bring back inflation. And the other thing is rural distress, again, will be aided if you bring back inflation, because inflation is ultimately a cost to the middle class, which is urban middle class. It's a big boon to rural India, which are the producers of the goods that comprise the inflation basket. So your rural distress will leave as well. So devalue the currency, bring back inflation, bring in foreign capital because of the devalued currency. You kickstart domestic, but then exports, the other thing I forgot. Exports will take a big boost up, because that is the other thing to boost GDP growth. You need to boost net exports. You're languishing, you're in big trouble on exports. Bring back the enthusiasm to exporters, and now we have a 20% booster. And then you'll have import protection because of the cheaper, it's more expensive rupee. I mean, that is my prescription. Thank God they know how to listen to it. But this is my line of thinking.
Now that's going to happen, because we know the central bank has been an inflation warrior for times to come. So I don't think that's a very easy step, like you're saying. But Shankar, I mean, as an investor, then you wonder, what is it that you should do? Because there are other asset classes which are not performing, and now equities are also not. So as an equity market investor, what is the right strategy?
In equity market, I don't see too much of a silver lining. I mean, like I've always said, small caps I've always liked. I continue to find value there. That does not mean they cannot fall 20%. And there is widespread price in businesses. It will look very long, very hard to find even a single stock where you want to put some sizable money. It's a very, very tough environment. And the large caps, the less the better. As we mentioned, as we discussed, it was a very narrow bull market, and I think we had in maybe April or May. An extremely, extremely narrow bull market. Narrow bull markets always end badly. I tweeted about it in April that the election results were a red herring. They won't matter. Ultimately, this market was toast. And we've seen some part of the toast already getting done. I don't think it's done yet, because the economic numbers do not suggest any immediate recovery. And if you're an investor, stay parked in a bank that is solvent. And that's all you can say. Because there's nobody, I don't think the average guy on the street is smart enough or equipped enough to go and find value in small caps. And the large caps don't look very, very good anyway. Buying, I mean, like I said, you have pockets with the insurers, the IT companies. I think those are okay places to be in if you're talking large caps. But otherwise, it's a tough equity market environment.
So how much more downside do you see to the market from these levels?
We can save that for the next interview,
Acha, till the next interview also, you will have more downside to stare at.
Are you in that kind of blue funk that you want to hear all the bad news in a single 20-minute interview?
No, not really. But I want to definitely pick up on the positives, Shankar. And, the PSU Bank recapitalization, which was announced by the finance minister. And we all know that, it's not like banks don't have liquidity. It's just that they've been shying away from lending to corporates. Would you say lending would come back to the system at all?
No, it will not. Banks are shy of lending, yes. Look, the interesting thing is the only sector, I was looking at 15 sectors data, the only sector that is exhibiting positive growth is consumer lending. What does that tell you? It tells you that consumers are borrowing, and now with the job losses, etc., I cannot believe anybody in his right senses is borrowing to buy a flat screen TV. I think they are borrowing to finance their other borrowings. So the consumer liabilities are increasing. Consumer savings, I think the data is very telling. Consumer savings are at all-time low. Consumer liabilities are at an all-time high. So you're hugely widening debt equity ratio at the consumer level. We had a huge problem. We've had a huge problem on corporate balance sheets. The national balance sheet itself is a bit of a pickle. And now your consumers, which have been the bulwark of our growth story for the last several years in the GDP terms, that itself is now taking a hit. So corporate India doesn't want to borrow because corporate India sees this consumer market and says, if my consumer itself is now going to be indebted, why will I take debt to put a capacity and try and sell my goods or my services to consumers? So the only area of financing that people want to take is equity money. That's it, because that's risk-free. So there are no collaterals, there are no strings attached, there's nothing. So we see money or public market money or private equity money. That's the only area people want to take money for, and not private equity of the kind we saw in the CCD kind of transaction. That's again debt masquerading as equity. So not that type, but I'm talking straight equity.
Sure. Shankar, what happens to consumption? The Nifty Auto Index has fallen 14% in the last 2 months. You've got the BSE consumer durables, consumer discretionary indices lost about almost 10% again in the last 2 months. With the measures announced on BS4, the fact that government is looking at replacing its old fleet, would that bring about at least a minuscule bit of pop-up within autos at least?
Let's hope so, and I really hope for the sake of India that if autos don't do well or autos tank, frankly, I don't see what else India manufactures, which is of global size and scale, and let alone what other sector employs as many people. You're talking crores and crores of people directly and indirectly engaged in the auto business. And if that business struggles or continues to struggle the way it is going to be doomsday for any Indian manufacturing sort of perspective, because that's the only thing where India has manufactured brilliantly. Other things are all very localized, jewelry, handicrafts, etc., which are very local to India. But on a global size and scale, only autos and auto ancillaries. And if that sector hurts like the way it is, and you have employment distress, I think it's really a bad situation. So I hope whatever has been talked about, works. I'm not sure it will, but, hey, it's a start.
Believe that this distress in the stocks is to be bought just yet?
Well, I always believe that either you are, you're buying something in which there is general uptrend, which is fine, or you buy something in which it was a falling knife, but you saw a bit of change in numbers. I remember in Maruti, we had kind of liked it in 2008, but the numbers were terrible. The only month in which they started to improve was October, November 2008, at the bottom of the recession. And when we saw 2 months of continual, I think some 20-30% kind of month-on-month growth, we said, all right, now the stock is there because the numbers have changed. And if you have 2-3 months of strong uptrend, you're buying something of value. Even though the stocks may well have run up maybe 20-30%, it doesn't matter. From there, Maruti ran up, I think, 10 times. So it is better to wait. Let's wait for an uptick on the numbers. Even if you're late by 20%, it really doesn't matter, because then you are buying something which is now started to move in the right direction.
Fair point. Shankar, just a word on which way is the globe headed, though, because you have a clear bird's eye perspective on that as well. Where do you think this entire situation between US and China is going to escalate to?
People keep talking about it. Excuse me, I'm having a bit of my omelette. Sorry about that.
Go ahead.
So the thing is, I don't think the U.S. is going to hurt in any way, from this. And when you are a $65,000 per capita GDP country, you don't hurt that easily. You're well endowed. You will manage things. And people start comparing America with India, and I say, boss, you're at 1,500 per capita. Worry about yourself. Don't worry about America. That has a very deep and liquid financing market. The credit markets and the equity markets, they froze only once in the last 3-4 decades that I've seen them already finished, 25 years, with the 2008, and they fixed it like in a fortnight. That's the kind of policy response I was talking about when I talked about policy responses, which clearly, in India, we work a little differently, at least now, these days anyway. So, the U.S., I don't think is in any problem. If there is any one market, which looks still very, very good, it is the U.S. Yeah, it will have its wobbles of the kind we saw, last week. There's no denying that fact. But I don't think, in the context of global equity markets, I don't see any market which rivals the U.S. That said, even the FTSE has done very well. The DAX has done pretty well. As long as your interest rates remain where they are and they head lower, I don't see what asset class can come and rival global equities. So I am very optimistic on global equities. Barring, like I said, wobbles here and there, but developed market equities, actually a lot of value. We've seen stocks. I have bought stocks in the U.S. which are up 15 times in the last 3 years. 15 times. I mean, where do you get returns of that kind in India? I mean, we're just, scraping at the bottom of the barrel. The IPO of Beyond Meat, I mean, I bought a bit of that in the IPO. That's up 9 times from me. I mean, where do you find these kind of returns? So I'm optimistic on the U.S. I'm optimistic on global equities, particularly developed market equities, because when you have such low interest rates, the only other asset class that does well is equities. Precious metals, fine, no problem. They're looking okay. Other than that, emerging market equities, here and there, they're okay, but nothing worth writing home about. Overall, if you take a top-down approach of where the world should be trading and where it is trading.
So you're not worried about the inverted US yield curve and the fact that just everyone is talking about an impending recession in the US?
I've said this, that there's not enough data to say that there are not that many inverted yield curves we've seen anyway in the last 100 years. I think maybe 4 or 5. And yes, they have portended a recession. But that's too few data points, and I don't like making conclusions on that few data points. I mean, I've always seen, in my experience of decades doing this game, you need hundreds of data points to start to even conclude that X will be too wide. Otherwise, it may or may not work. And many times, even hundreds of data points, your why may not happen. So, here you're talking about 4 or 5 occurrences, and we are assuming the 6th one will happen. I will hold my horses. I don't think it's necessary, or it's a necessary corollary to an inverted yield curve that you're going to get a recession in the U.S. We'll see, but I'm a little bit of a skeptic on that.
Okay. On that note, Shankar Sharma, pleasure speaking with you. We'll leave you back to your breakfast. Thanks as always.
Thank you very much. I appreciate it. Thanks.